Hi everyone, and welcome to the Buffett and Beyond Stock Selection Strategies. And remember, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Wareen Buffett. And we will teach you how to construct your own portfolio through the use of our podcasts, our daily market letters, our weekly video stock analysis, and our proprietary computer program. Hi folks, this is your host, Dr. Joseph Belmonte, along with Debbie, and that's Debbie with a Y, and all the questions she has from our listeners out there in investment land. And before we get to our podcast today, if you want a free sample of all our materials, just go to our website, buffettandbeyond.com, and sign up for our 30-day free trial, which contains all of our information along with access to our computer program. And remember, it's free for 30 days. So yes, we will teach you how to invest like Warren, but you've got to figure out how to live like Jimmy all by yourself. And just before we get to our stock questions sent in or called in by your listeners, I want you to understand that we use a method of comparability called clean surplus. Clean surplus is an accounting and finance model that allows us to compare stocks to each other regardless of their industry. And clean stands for comparable and surplus stands for profits. And clean surplus is the only, and folks, I repeat, the only researched and tested method of comparability that allows us to compare stocks in the exact same way that we compare the returns given to us by banks. And folks, it is this simple. If Bank A is giving us a return of 10%, while Bank B is giving us a return of 5%, then we would certainly invest in Bank A. Now, really, isn't that bank interest a return on equity? Yes, it is, and that's how we compare stocks. So the bottom line key to building a better than average performing portfolio is to select stocks that have clean surplus ROEs, return on equities, higher than the average stock in the S&P 500 index, which is the benchmark for the investing world. Now remember that over any 1 year period, 75% of mutual fund portfolio managers cannot outperform this index, and over any 10-year period, 96% of mutual fund portfolio managers cannot outperform the S&P 500 index. This means that just 4% of portfolio managers can outperform this index over time. And folks, the Buffett and Beyond method of stock selection puts us in that 4% category. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. And Debbie, what's our very first question of the day?
All righty, JB. Hello, everybody. Our first listener emailed us and wanted to know what was going on with Scripps. This company has interests in television and digital media brands and its own 33 TV stations in 24 markets and their digital assets.
And remember, folks, we want to look at the clean surplus return on equity, which is totally different than the traditional accounting return on equity. Totally different. And folks, that's what my book is all about. That's what all the information on our website is all about. So now that we've got that straight, we want to outperform the S&P 500 index, which so very few people can do. And in order to do that, we must fill our portfolio with stocks that have an ROE, a clean surplus ROE, greater than the average stock. Just like a bank account, we want to outperform the average bank. We have to go to the bank that has a higher interest or return on the money that we put in there. So the average stock in the S&P 500 has an ROE of 14.5%. And we look at Scripps Network, and it has a clean surplus return on equity of about 2.4%. Folks, that's way below the average. And if we look at the debt, it has way too much debt, twice as much debt as we want in any stock that we buy into. So Scripps Network is not going to be a stock that we will look at any further. With the clean surplus return on equity of just 2.4%, projected for 2019, it is way below the average stock in the S&P 500. So Debbie, let's go right to the next stock.
Alrighty then. Our next listener says she shops in Costco all the time, and she says she has a hard time finding a parking space within a mile of the store. Well, we can all relate to that, can't we, JB?
Sure do.
Well, she's wondering with all the traffic if it's time to buy the stock.
Well, again, we'll look at Costco. That stock symbol is COST, like cost. And we will look at the clean surplus return on equity. And we see that for 2019, it is projected to be almost 22%. So, yes, this ROE of this stock of Costco is way above the average stock in the S&P 500. The next thing we want to look at is debt, and it has very, very low debt. So it has a high clean surplus ROE, and that ROE has been going up over the years. And folks, if you watch this podcast from our website, you will be able to see the video of the table of this stock, so you can see exactly what we're talking about. But for you folks who are not looking at the podcast from our website, all you have to know is the average bank out there is returning 14%, and Costco is returning 21.8%. We would certainly expect this stock to outperform the average stock over any 1-year period and over any 5-year period. So Costco is a go as far as we're concerned. All right, Debbie, let's get on with the next stock.
All right. Well, Mickey kind of thinks there's something goofy going on with Disney stock. Well, it seems that there are more people in Disneyland than in all the Costco stores combined. And Nikki wonders if all those people translate into increasing stock prices.
Well, I'm going to the table on Disney, and we can see that their clean surplus return on equity is about 15.7% for 2019. So that's slightly above the average stock in the S&P 500. So Disney, yes, is a little bit better than the average stock in the S&P 500, but we would like to see Disney with a higher ROE. And folks, 20 years ago or so, it did have an ROE of over 20%. And in order to get into our growth portfolio, we want to see ROEs above 20%. Now, Disney is probably an average stock or a little bit better than average as we go along, because the ROE, clean surplus ROE, is slightly above the average stock in the S&P 500. Okay, now that we have gone over 3 stocks, we will look at the 3 stocks together, and let me give you a synopsis if you're not watching this. And the average stock in the S&P has an ROE of about 14%. Scripps with 2.4% ROE. Think of your bank account. It's way below the average bank. We would expect it to underperform the S&P 500. Meanwhile, Disney with an ROE of 15.7% for next year would be slightly ahead of the average stock in the S&P, and I say slightly. And then Costco with a 21.8% ROE. And remember, folks, to get into our portfolio, our growth stock portfolio, we fill that growth stock portfolio with 30 stocks each year. And I'll tell you what, over the years, they stayed the same. We only replace about 5 or 6 stocks a year. And Costco is not in our growth portfolio, but now looking at this ROE of 21.8%, it's above the 20% threshold. We are going to take another look at Costco for our growth portfolio. But for right here, right now, we would expect Scripps to underperform the S&P, Disney to perform a little bit better than the average stock in the S&P 500, and Costco to way outperform. And we're looking at 1 year for these 3 stocks, and we see the S&P up about 14%, with Disney up just about 3%. And we see Scripps way down at a negative 35% this year. That's terrible, folks. And Costco up about 35%. So as was predicted, Costco way outperforms the S&P 500, with Scripps underperforming by an awful lot, and Disney underperforming the S&P 500. It didn't do as well as the S&P. Now, looking over 5 years, we see Disney actually outperforming the S&P 500, but it's close. The S&P 500 has about a 65% return, and Disney has about a 72% return over 5 years, with Costco up around 90%. And Scripps down about a negative 15%. So if we look at the highest and the lowest, now the Costco was the highest ROE in this group, and it way outperformed the S&P 500 over 5 years. Scripps had a very, very low clean surplus return on equity, and it underperformed the S&P 500 by about, we're looking at about 90%, because the S&P was up about 65%, and Scripps was down a negative 15%.
All righty, JB. Well, that's about it. We've answered all the questions from the listeners this week, but you did promise to go over Netflix next week since we have the stock in our growth portfolio.
Yes, we will go over the numbers on Netflix as those numbers have changed over the past few weeks. And I just want to remind you listeners that if you want our 30 stock growth portfolio for this year and a 30-day free trial on all the information that we publish for our subscribers, just go to our site at buffettandbeyond.com. Buffett is spelled with 2 F's and 2 T's. Buffett and Beyond, Buffettandbeyond, so it's all one word with and spelled out, 2 F's and 2 T's, and sign up for that free information.
And don't forget to mention your book, JB.
Oh, yeah, the book.
Oh, yeah.
The book is what's behind all of this, folks, and this is the second edition, published by Wiley Publishing, and it is based on my doctoral dissertation and 16 years of actual portfolio implementation. Folks, it's going to be the only book you will need to understand how to invest better than most of those pros out there in investment land. Okay, folks, we had a great day today. And don't forget, if you want to see these tables and charts in living color with circles and arrows on each one.
All the pretty colors.
All the pretty colors. Just go to our website, buffettandbeyond.com, click on podcast, and click on the most recent podcast, and it'll be all there for you. And okay, folks, we had a great day today.
And tomorrow will be even better.
So remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We had a pretty good week. So, folks, you have a nice, safe weekend, and we will see you next time.